Mild gains for PCE closes out a rollercoaster month for Wall Street. Welcome to Market Insights. I'm Peter Devlin. The Fed's preferred inflation rose at a mild pace last month. August started with a bang as markets plummeted on US growth fears and the unwinding of some crowded trades. For all the recent volatility, the Dow and S&P 500 look set to end the month in the green. So what challenges lie ahead in September? So joining me now to talk about all that is Brian Krawez, lead portfolio manager at Scharf Investments. Welcome, Brian. So starting off with today, the PCE data. Does this check the box for Fed cuts in September?
Yeah, I think it does. It was broadly in line with market expectations. There was a speech this week by Fed Chairman Powell where he said he had confidence they were on path to 2%. And I think this helps support that.
So as well, dominating next week is the US job numbers. Could a weak figure prompt a jumbo cut from the Fed, or are you resolute in your 25 base point call?
Yeah, I mean, if it was really weak, perhaps 50 basis points would be on the table. But, we think it's likely 25 and there's likely three more cuts this year. There was nothing in this data or in Chairman Powell's speech that would lead us to believe there's a need to panic. We don't think the Fed's going to want to, signal to markets the need to panic either. So it's just likely, regardless of the jobs number, that you're going to get 25 bips and then a continued 25 bips from there.
So with panic in mind, Bank of America analysts say that stock market volatility does tend to rise in September and October. Are we in for a bumpy few months ahead?
There is oftentimes some bumpiness in September, October. Right now the markets have been pretty calm. But there is historically some bumpiness that could be coming. It really will depend. I mean, one thing we got is the election, and obviously there could be some stuff coming out of that. We'll see how earnings are. At the end of the day, what really matters is to investors is fundamentals, and so far those have been coming in reasonably good.
So markets as well have been long awaiting an interest rate cuts. Where should investors now be looking ahead of the easing cycle?
This has been a really concentrated market. The top 10 stocks have been roughly 70% of the return of the S&P this year, and that's very, very unusual because usually those large stocks are lagging by about 2 to 2.5% per year. And so as a result of that, you've now got 37% of the S&P 500 is just in the top 10 stocks. This is well above, the market peak of the bubble, even in 1999. So, we think there's some caution warranted. In good news, the market seems to be broadening out. 62% of the S&P 500 stocks have beaten the S&P over the past month. That compares with only 15% that outperformed over the past year. So we think there's opportunities for investors willing to look outside those concentrated winners. One name we like is U-Haul. Trades at only 1.5 times book. It's got a very dominant market position, well-known name brand in the United States. Fantastic growth prospects as they're growing that self-storage business. And on top of that, they're going to be a beneficiary as the Fed eases rates, which will help the housing market and help them as well.
So as well, the University of Michigan survey showed a modest improvement in consumer sentiment this month. Will that translate to strength in retailers?
You just saw Dollar General's down 30+% yesterday. One of the things from the report this morning is that savings rates actually dipped down to 2.9%. That's the lowest we've seen in several years. The consumer was fairly strong because they got a lot of savings that was built up during the pandemic. But what we've seen from the Dollar General report and some others is that particularly the low-end consumer, there's starting to be some stress there. The areas that are doing well is more value. People are really looking more for bargains now on the consumer side. And so I think that'll be a much bigger driver going forward. And we'll have to see if consumer sentiment, comes down as the labor market is softening.
So that improvement in the consumer sentiment was also due to a shift in political expectations. So is it time to abandon the Trump trade, and is there a Kamala Harris trade?
It's hard to know who's going to win. And so I think investors probably are best off not putting too much stake in any one candidate winning right now. Instead, have a balance, of stocks that can benefit. We like certain stocks like Occidental Petroleum, and Gentex that'll probably benefit from a Trump win. However, there's plenty of stocks that'll do well regardless of who wins. A name like U-Haul we think will do well regardless of who wins. And so again, I think investors should really just focus on fundamentals. There's been a lot of optimism with the S&P 500 at 22 times right now, which puts it the top 10 percentile in terms of expensiveness. So we think investors are really quite giddy right now and seem to be betting on the Fed sticking a soft landing. We actually think for our part that there is real risk of recession because the fact of the matter is soft landings almost never happen. And so we think, investors right now should be focusing on those companies with strong fundamentals, regardless of who they think is going to win the election.
Brian Krawez of Scharf Investments. Thank you very much for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.